Most people believe that keeping their money safe means leaving it in the bank, right? It's insured, it's safe, and you earn a little bit of interest. But what if I told you that in today's world, that might not be the best idea? With inflation and low interest rates, your savings could be losing value. When was the last time you looked at the interest rate on your savings account? It's probably close to zero, right? And with inflation running high, your money is actually losing value every single day that it just sits there. But what's the alternative? You're not just going to stuff your money under a mattress, right? That's why in this video, I'm breaking down 6 assets that are better and safer than holding on to cash. These assets have the potential to outperform inflation, grow your wealth over time, and provide you with some much-needed peace of mind. Stick around to the end, and I'll share a quick tip to balance risk and reward while protecting your hard-earned money. First up, real estate. Real estate is a tried and true investment. It offers both value appreciation over time and passive income through rent. When you invest in real estate, you're buying a tangible asset that people need, a place to live or work. As cities grow and populations increase, the demand for housing continues to rise, which generally pushes prices up. Real estate can be a hedge against inflation, preserving your purchasing power over the long term. Every month you collect rent checks from your tenants, creating a steady stream of cash flow. And let's not forget about the tax advantages. Real estate comes with a bunch of tax benefits, such as deductions for mortgage interest, property taxes, and depreciation. So if you're looking for a reliable way to build wealth, generate passive income, and hedge against inflation, real estate should definitely be on your radar. Next, we have stocks and ETFs. While the stock market can be volatile in the short term, historically, it's provided an average annual return of about 7 to 10%. That's way better than the interest rate on your savings account, which, let's be honest, is probably closer to zero right now. When you invest in stocks, you're buying a small piece of ownership in real companies. As those companies grow and become more profitable, the value of your shares increases, and you benefit from their success. You can buy individual stocks or invest in ETFs, which are baskets of stocks that spread your risk. ETFs, or exchange-traded funds, are like baskets of stocks that track a particular market index, like the S&P 500 or the NASDAQ 100. Instead of betting on a single company, you own small pieces of many companies, lowering your risk. Now, if you're thinking, but stocks are risky, just wait until we cover the next asset. Gold and precious metals. These have been used as a store of value for centuries. Gold is a tangible asset with intrinsic value, meaning it has worth in and of itself regardless of economic conditions. When the economy is shaky, gold usually shines. It's seen as a safe haven asset, meaning that when markets are down, gold prices often go up. Unlike paper currencies, which can be printed endlessly and lose value over time, the supply of gold is relatively limited. So when people are worried about the value of their money, many turn to gold to protect their wealth. Let's talk about bonds. Think of bonds as the reliable, steady eddy of the investment world. In simple terms, these are loans you give to governments or corporations, and in return, they pay you interest. While bonds don't offer the high returns of stocks, they're considered safer. Government bonds especially are low risk and provide steady income. They're backed by the full faith and credit of the issuing government, which makes them one of the safest investments you can make. Bonds provide stability and balance to your portfolio, acting as a counterweight to the more volatile investments like stocks. Bonds can act as a cushion during market volatility, providing you with reliable returns when other assets are down. Cryptocurrency, love it or hate it, you can't ignore it. Bitcoin, Ethereum, and other cryptocurrencies have exploded in popularity over the past few years. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They're decentralized, meaning they're not controlled by any government or financial institution, and they operate on a technology called blockchain. While they can be very volatile, they've also offered some of the highest returns. I mean, we've seen Bitcoin go from being worth a few cents to tens of thousands of dollars a piece. Now, I'm not going to sugarcoat it. Cryptocurrency is still a very new and evolving asset class. It's risky, but for those willing to tolerate some ups and downs, it can provide significant returns. Last but not least, peer-to-peer lending. This is where you lend money directly to individuals or businesses via online platforms. In return, you earn interest. It's a more modern way to invest compared to traditional banking, and it often offers higher returns than a savings account or even bonds. Instead of going through a bank to get a loan, borrowers can apply for loans through these online platforms, and investors, like you and me, can choose to fund those loans. The platforms act as intermediaries connecting borrowers with investors, and they handle things like credit checks, loan disbursement, and payment collection. The interest rates on peer-to-peer lending platforms are often higher than what you would get from traditional savings accounts or even bonds. So, if you're looking for a way to earn potentially higher returns on your money while helping individuals and businesses access credit, peer-to-peer lending might be worth exploring. So what's the takeaway? Diversification. Instead of leaving all your cash in the bank, spread it out across different assets like real estate, stocks, bonds, and even a bit of crypto if you're feeling adventurous. This way, your money works for you, grows over time, and is better protected from inflation. Remember, the key is to find the right mix of assets that align with your risk tolerance, financial goals, and time horizon. Your future self will thank you. Which of these assets are you most interested in? Let me know in the comments, and don't forget to like and subscribe if you found this helpful. Until next time, keep building your financial future.